So usually when we think about the stock market, we picture this, this incredibly orderly institutional environment.
Right, like a very controlled space.
Exactly. Think of it like a massive, slow-moving cargo ship.
Yeah.
And the captains of that ship are these multi-billion-dollar hedge funds, the sovereign wealth funds, these giant asset managers.
The whales.
Right, the whales. And they steer the vessel with these very deliberate, quarter-by-quarter macroeconomic decisions. But if you actually look at the tape right now, like specifically in the derivative space, it's a completely different picture.
Oh, totally.
That cargo ship is basically just completely surrounded by this massive swarm of high-speed jet skis.
I love that analogy. Jet skis zipping everywhere.
Right. They're just zipping around, changing direction on the dime. And the people driving those jet skis, they aren't institutional whales at all. They are everyday retail traders, just, regular people.
Yeah. And we are really witnessing a complete rewiring of the market's microstructure because of it. The liquidity profile of the modern market, it's no longer dictated solely by those giant cargo ships. It is increasingly driven by that exact swarm of jet skis you're talking about.
Yeah.
Which brings this fundamentally different type of volatility and honestly just sheer volume to the table.
Yeah. And that brings us to our focus for today. Welcome to a special Talk Tickers edition of our Deep Dive.
Glad to be here.
Today, we are looking at the company that essentially, they sell the jet skis, they build the docks, and they run the entire marina for this crazy new market environment.
The whole infrastructure.
Exactly. We are breaking down the Q2 2026 earnings call for Cboe Global Markets. Ticker symbol is CBOE.
A fascinating call to dig into.
It really was. And our mission here is to kind of cut through all the corporate fluff, extract the most critical data points from the transcript, and really translate those underlying mechanics for you.
So you get the real story.
Right. So you have a clear, highly actionable verdict on whether this stock actually belongs in your portfolio.
And, Cboe's footprint in the whole financial plumbing system is just massive.
No, it's huge.
We are talking about the operator of some of the most critical options, equities, and foreign exchange platforms globally. And the hook for this quarter's earnings call, it's phenomenal.
Yeah, a total blowout.
They posted a record-breaking quarter.
Yeah.
The catalyst isn't traditional institutional hedging like you might expect.
Right.
The engine driving this growth is that retail engagement. It's that everyday trader heavily participating in these complex derivative products.
So let's get straight into the headline numbers here, because the data paints a very, very aggressive picture.
It really does. Let's hear them.
So net revenue hit a record $731.6 million.
Wow.
Which is a 25% year-over-year increase. And we usually see those kinds of growth multiples in early stage tech.
Yeah, definitely not legacy financial exchanges.
Exactly. Not a regulated exchange. But the bottom line is honestly even more aggressive. Their adjusted diluted earnings per share came in at $3.56.
And putting that EPS in context is just vital here. Earning $3.56 per share, that represents a 45% increase.
45%.
Right, compared to the $2.46 they reported back in the second quarter of 2025.
That's insane.
It is. You simply do not see a mature, highly regulated exchange compounding its bottom line by 45% in 12 months unless
there's a fundamental change.
Exactly, unless there is a structural shift in how their platform is being utilized.
Right.
Furthermore, management was very careful to note on the call that this wasn't just like a localized beat in one department.
Yeah, it wasn't just a fluke.
We were looking at double-digit net revenue growth across every single major category they operate in.
Every single one. And as an investor, seeing 45% EPS growth layered over a 25% revenue growth, that immediately triggers a conversation about operating leverage.
Oh, absolutely. Operating leverage is the key here.
For anyone holding this stock, that math is basically the holy grail.
Right.
It means the cost of processing the next transaction is virtually zero.
Right.
Because Cboe essentially acts as a digital toll booth.
That's a great way to think about it.
Right. They spend heavily upfront to build the matching engines, the giant server farms, all those high-speed fiber optic networks.
The heady infrastructure.
Exactly. But once an infrastructure is live, their fixed costs are mostly locked in.
Yeah, the pipes are already laid.
So if trading volume spikes from, say, 1 million contracts to 2 million contracts in a day, their expenses do not double. The revenue from that incremental volume falls almost entirely to the bottom line.
And the transcript backs up that operating leverage thesis perfectly. Jill Griebenow, who is Cboe's chief financial officer, she pointed out that adjusted operating expenses for the quarter were $217 million.
Okay.
That is only a 2% increase year over year.
Let that sink in. A 25% surge in revenue, but only a 2% increase in the actual cost to run the business.
It's incredible math.
And looking at the breakdown, that 2% bump was actually largely driven by higher compensation accruals.
Which means bigger bonuses.
Right, essentially paying out bigger employee bonuses because the company was just crushing its targets. So the result of all that is an adjusted operating EBITDA margin expanding by 6.4 percentage points.
Which brings it to what?
It hits 72.2%.
A 72.2% margin is just structural dominance.
It's wild.
To compare that for you, a highly successful grocery chain might operate on a 2% or 3% margin.
Right.
Even a massive enterprise software company might consider like 40% to be a major victory.
Right, they'd be thrilled with 40%.
Right, but Cboe is retaining over 72 cents of every single operational dollar they generate before depreciation and amortization.
That is a phenomenal cash generation engine.
It really is.
But it forces us to ask the skeptical question, right? Like, what exactly is generating this crazy volume, and is it sustainable?
Yeah, we have to look at the composition of that revenue to really answer that.
Definitely.
And the undisputed heavyweight champion of this earnings call was their options business.
Yeah, options were massive.
Options net revenue came in at $473.9 million, which is up 30% year over year.
Wow.
And digging into the actual volume, their index options average daily volume, or ADV, hit a new quarterly record of 6.2 million contracts.
6.2 million every single day.
Right. That's a 32% year over year volume increase just in that segment.
And within that 6.2 million contracts, there is a very specific behavioral shift occurring that we need to talk about.
Oh, the zero DTEs.
Yes, we were talking about the absolute explosion of zero DTE contracts. That stands for 0 days to expiration.
Which is what exactly? For those who don't trade them.
Right. These are options contracts that expire on the exact same trading day that you purchase them. So you buy it in the morning, and by the closing bell, it's either paid out or it's totally worthless.
Hyper fast.
Hyper fast. And Cboe's management revealed that 3.1 million SPX zero DTE contracts traded daily in this quarter.
So that's literally half.
Yes, half of their entire index options volume is now dedicated to this intraday expiration.
That's a massive shift.
But the catalyst for this specific quarter surge is what makes this so actionable. Management pointed directly to the repeal of the pattern day trader rule, or PDT rule.
Ah, yes, the PDT rule.
They said that was the exact spark that ignited a massive volume jump in June.
But we should probably explain the PDT rule because it was a massive regulatory friction point for years in the retail space.
Oh, it was universally hated by retail traders.
Totally. Historically, if your brokerage account held less than $25,000 in equity, regulations restricted you from day trading freely.
Right.
You were limited to executing no more than 3 day trades within a rolling 5 business day window.
Yep, the 3 trade limit.
If you executed a 4th, your broker was legally mandated to lock your account from day trading for 90 days.
Which is just a brutal penalty. It was this highly paternalistic regulation, honestly. It was designed back in the late 90s to protect retail traders from the volatility of the dot-com bubble.
The idea being that day trading is dangerous.
Exactly. The logic was that intraday trading is inherently risky, so if you don't have this arbitrary $25,000 buffer, you shouldn't be engaging in it at all.
Right.
But the practical reality of that rule was that it actually forced retail traders to take on overnight risk, which can be even worse.
Way worse, yeah.
Like imagine you bought an option on a Tuesday morning, right? And it rallied 40% by Tuesday afternoon. Naturally, you might want to sell it and lock in that profit.
Make your money and get out.
Exactly. But if you were already out of your day trade allowance for the week, you couldn't sell. You were physically forced by your broker to hold it overnight.
Which exposes you to so much risk.
So much risk. You're exposing yourself to after-hours news, gap downs at the next morning's open, and just the severe time decay on the option premium itself.
So you could wake up Wednesday morning and that 40% gain is instantly a 20% loss.
Exactly. It was a terribly flawed system. And the repeal of that rule just fundamentally altered retail trading behavior.
Right. Craig Donohue, Cboe CEO, explicitly noted the immediate impact of that repeal on the call.
What did he say?
He said by removing that $25,000 gatekeeper, retail traders were suddenly free to enter and exit these intraday positions dynamically whenever they wanted.
Finally.
And the result was SPX 0 DTE volume jumped 11% month over month in June alone. Just a massive spike.
And the demographic shift in that volume is the real story here. Retail traders made up an estimated 57% of that 0DTE volume in June.
57%?
Yeah, which is up from 53% in April and May. And think about this. The S&P 500 index option, the SPX, has historically been the premier institutional-grade hedging instrument for global finance.
Right, it's a very serious tool.
It's the tool multi-billion-dollar funds use to insulate their giant portfolios.
Yeah.
And now, well over half the volume in the hyper-fast, zero-day version of that exact product is originating from retail accounts.
Which is just a wild paradigm shift. But that volume dominance, it inevitably invites criticism, right?
Sure.
The prevailing narrative in financial media right now is that retail 0DTE trading is just purely speculative gambling.
Yeah, you see those articles everywhere.
Critics argue that giving everyday traders unfettered access to these highly leveraged intraday derivatives is a systemic risk, and that it will ultimately end in retail portfolios just being completely wiped out.
And I mean, I understand the concern. On paper, when you mix high leverage, extreme time decay, and retail momentum, it definitely sounds like a recipe for a massive wealth transfer from retail to the market makers.
Right, it sounds like a casino.
But Rob Hocking, who is the global head of derivatives at Cboe, he actively dismantled that narrative during the Q&A portion of the call.
Oh, he really went after it.
He did. He drew a very specific technical contrast between Cboe's 0DTE options and the perpetual futures that are heavily traded in the crypto markets.
Yeah, and the distinction Hocking made there centers entirely on the concept of defined risk.
Right.
A perpetual future in crypto is a derivative contract with no expiration date, and it allows for immense leverage, sometimes 50x or even 100x.
It's crazy leverage.
And the risk profile there is linear and completely unbounded.
Meaning your losses can keep growing.
Exactly. If the market moves violently against your position, your losses scale proportionally. You can easily get liquidated, lose your entire account balance, or in certain unregulated offshore structures, you can actually end up owing the exchange money.
Which is terrifying. But Cboe's options operate on a fundamentally different math.
Right.
An option contract provides convexity and, crucially, a hard floor on your losses.
The defined risk.
Exactly. If you purchase an option premium for, say, $200, your maximum possible loss is capped at that $200.
No matter what happens to the market.
Right. Regardless of whether the underlying index drops 1% or drops 20% in some crazy flash crash, your downside is strictly limited to the initial capital you deployed to buy the contract.
Right.
You still maintain exposure to those outsized upside moves, but the catastrophic tail risk of, actually owing the broker money, that is structurally removed.
And Hocking actually brought data to the call to prove that retail traders understand this mechanic.
The data was fascinating.
He noted that over 95% of the 0DTE trades they process are defined risk strategies.
95%. So they aren't just writing naked options.
Exactly. And even more compelling than that, 50% to 55% of those retail trades are specifically constructed as spreads.
Okay, let's break down the mechanics of a spread really quickly, just to show why that statistic is so important for the bull case on this stock.
Yeah, it shows sophistication.
Right, because if a retail trader just wants to blindly gamble, they usually just buy a naked out-of-the-money call option.
A lottery ticket approach.
Exactly. It's cheap, it's highly leveraged, and frankly, it usually expires worthless.
Yeah.
But a spread involves simultaneously buying and selling options on the exact same underlying asset. So for example, in a vertical call spread, you buy a call option at one strike price and you sell a call option at a higher strike price.
And the premium you collect from selling that higher strike option directly offsets the cost of buying the lower strike option.
Wait, excuse me. You offset the cost, which significantly lowers your initial capital outlay.
Right.
It does cap your maximum potential profit, sure, but it mathematically reduces your breaking point and strictly defines both your floor and your ceiling.
It's a much smarter trade.
The fact that over half of the retail 0DTE volume consists of these multi-leg spreads, it indicates these aren't just gamblers throwing darts at a board.
No, not at all.
These are market participants actively deploying sophisticated strategies to manage their cost basis and carefully structure their risk parameters.
And Cboe has actively leaned into accommodating this smaller, more sophisticated retail participant.
They really have.
We see this clearly with the XSP product, the Mini-SPX.
Oh yeah, the XSP.
It represents 1/10 the notional size of the standard SPX contract, making it much more accessible for smaller accounts.
It's perfectly sized for retail.
Right. And management highlighted that XSP volumes surged 37% from May to June alone.
Just in 1 month.
Yeah, representing an 80% growth rate year over year. That exponential growth in a fractional product, it directly validates the thesis that retail traders are actively seeking out capital-efficient ways to trade index volatility.
Totally. And, while the transaction volume in the options business is understandably stealing all the headlines, we cannot ignore the recurring revenue engine they are building with Data Vantage.
Oh, the data side is crucial.
This is their proprietary market data division. Data Vantage net revenue came in at $177.8 million, which is up 15% year over year.
Steady, reliable growth.
But the truly vital metric here is the geographic distribution of that growth. Fully 50% of the new sales for the quarter originated from customers outside the United States.
That's a huge data point. 50% international.
Right. And to understand why international institutions are paying a premium for Cboe's data, we have to look at the macro concentration of global wealth right now.
Right, where the money actually is.
Craig Donahue cited a staggering statistic on the call. He said U.S. equity market capitalization surged past $75 trillion in June of 2026.
75 trillion? It's hard to even wrap your head around that number.
It really is. And that represents approximately half of all global equity value.
Wow.
So when you have $75 trillion concentrated in one domestic market, the S&P 500 effectively becomes the benchmark for global capitalism.
It's the center of gravity.
Exactly. Over $20 trillion globally is directly indexed or benchmarked to the S&P 500. So if you are managing, say, a sovereign wealth fund in the Middle East or a massive pension portfolio in Tokyo,
you're watching the U.S. markets.
You have to. You cannot successfully hedge your risk or allocate capital without granular millisecond level data on what the U.S. markets are doing.
Right.
You need to see the options order flow, you need to monitor intraday volatility, and you need to see exactly where the liquidity is clustering.
And Cboe basically owns the proprietary feed for the most critical hedging instruments in the world.
They own the pipes.
Yeah. And these institutions, they aren't just relying on the public SIP, the Securities Information Processor, because that public feed can suffer from latency.
And milliseconds matter.
Absolutely. Institutions require the direct proprietary feeds from Cboe to execute complex algorithmic trades and to avoid latency arbitrage. Okay, Cboe provides that mission-critical infrastructure. And because it's sold on a subscription basis, it creates this highly predictable, recurring revenue stream.
Which investors love.
Oh, they love it. It insulates Cboe's balance sheet from the inevitable ebbs and flows of everyday transactional trading volume.
Right, because trading volume can be choppy, but those subscriptions renew every month.
Exactly.
So all of this current performance we've discussed is excellent. But, Wall Street is inherently forward-looking.
Always looking ahead.
The valuation of Cboe stock depends entirely on their ability to sustain this momentum into the future. Which brings us to their management guidance, where they basically map out their expectations for the remainder of the year.
And the guidance was very strong.
It was. Management significantly raised their total organic net revenue guidance for 2026. They moved from projecting low double digits to mid-teens growth to definitively guiding for mid to high teens growth.
And bumping top-line revenue guidance by several percentage points midway through a fiscal year. That is a highly confident signal.
Extremely confident.
It indicates they have high visibility into their order book and their subscription pipeline. And it shows they believe the surge they saw in June following the PDT repeal, it wasn't just a one-month anomaly.
Right.
They see it as the new elevated baseline for market activity.
Yeah, but paired with that revenue upgrade was an upward revision in capital expenditures, or CapEx.
Ah, right.
The spending. They originally guided for CapEx in the range of $73 million to $83 million. But on this call, they bumped that spend up to a range of $98 million to $108 million.
That's a noticeable jump.
It is. And normally, an unexpected $25 million increase in capital expenditure would really spook the market.
Right.
Investors generally hate surprise costs.
Sure, cuts into free cash flow.
But the narrative behind this specific capital deployment is perhaps the most strategic element of the entire call.
I completely agree.
They are aggressively investing to build out their global clearing infrastructure, specifically aiming to launch something called Cboe Clear US.
And controlling the clearing mechanism, that is really the final piece of vertical integration for an exchange.
Exactly. Can you explain how clearing currently works for them?
Yeah, so currently, when an options trade is executed on Cboe's matching engine, the responsibility for guaranteeing that trade actually settles.
Meaning ensuring the buyer gets the contract and the seller gets the premium.
Right, exactly. The responsibility for that falls to a centralized clearinghouse, which is predominantly the OCC, the Options Clearing Corporation, here in the U.S.
So Cboe executes the trade, but the OCC clears it.
Precisely. The OCC acts as the ultimate guarantor of the market. If a massive hedge fund writes thousands of naked call options and the market moves violently against them and the fund defaults—
A nightmare scenario.
total nightmare. But the OCC's clearing mechanics and their default waterfall step in to ensure the counterparty is still made whole.
Got it.
It prevents localized defaults from causing systemic financial contagion.
Right. But because the OCC absorbed all that systemic risk, their process for approving and clearing novel, new derivative products is incredibly rigorous, conservative, and honestly, very slow.
Very slow.
They require extensive margin modeling to ensure they can adequately collateralize any new product before they ever allow it to trade.
And Craig Donahue was, he was diplomatic about their relationship with the OCC on the call, but the subtext was just crystal clear.
Oh, completely.
If Cboe relies entirely on a third-party clearinghouse, their pace of product innovation is tethered to the OCC's risk appetite and their bureaucratic timeline.
Which is too slow for Cboe right now.
Way too slow.
Yeah.
By building Cboe Clear US and registering directly with the SEC as a covered clearing agency, Cboe takes ownership of the entire life cycle of the trade.
They execute it, they route it, and they clear it.
Exactly. Full vertical integration.
And that vertical integration is not just an efficiency play to save money. It is a highly offensive strategy designed to accelerate the deployment of two incredibly ambitious initiatives they discussed on the call.
The 23x5 initiative being the first one.
Right. The first is altering the temporal boundaries of the market itself. Management announced they are targeting December 2026 to transition their cash equities trading to a 23x5 schedule.
Meaning keeping the market open 23 hours a day, 5 days a week.
Exactly. Because, the core U.S. stock market currently operates on this rigidly defined 6.5-hour window, right? From 9:30 a.m. to 4:00 p.m. Eastern.
Which is so antiquated.
It is.
Yeah.
Because macroeconomic events do not adhere to New York trading hours.
No, they don't.
If a major geopolitical crisis erupts in Europe at 3:00 Eastern, or if a vital supply chain disruption occurs in Asia over the weekend, investors holding U.S. equities are currently just trapped.
Sitting on their hands.
Yes. They have to wait for the morning bell, agonizingly watching the pre-market futures bleed out, entirely unable to execute a hedge or liquidate their position.
And the demand for continuous liquidity has just been heavily normalized by the cryptocurrency markets, which famously trade 24/7, 365.
Exactly. Crypto never sleeps.
Right. Retail and institutional investors alike have been conditioned to expect instant, frictionless execution, regardless of their time zone.
They want to trade when the news breaks.
Yes. And Cboe is responding to that structural shift by expanding the availability of their cash equities market. They want to accommodate global participants who need to react to news in real time, completely bypassing that traditional market open bottleneck.
It's a huge move.
Yeah.
And while 23x5 trading expands when you can trade, their second big initiative expands what you can trade.
The KPI contracts.
Yes. In July, Cboe filed a brand new application with the SEC to list company-specific KPI contracts. KPI stands for Key Performance Indicator.
This is wild.
It's a massive departure from traditional equity investing. If you want exposure to a company right now, you just buy their stock.
Right.
But when you do that, you are taking on the aggregate risk of the entire corporation, right? Their debt load, their macro environment, and every single division's performance all bundled together.
Yeah, you get the good with the bad.
But KPI contracts allow market participants to isolate their thesis to a single hyper-specific metric.
And Rob Hocking used two prime examples on the call to illustrate this. He talked about trading a contract based solely on NVIDIA's data center revenue.
Just the data center revenue.
Right, or a contract based exclusively on Microsoft's cloud computing revenue.
So let's explore the mechanics of how this would actually function for an institutional hedger.
Yeah, let's play it out.
Imagine a massive asset manager holding $2 billion in Microsoft stock. Their internal modeling suggests Microsoft's core software business is incredibly strong, but they have a very specific fear that AWS and Google Cloud are going to eat into Microsoft's Azure cloud revenue this quarter.
A very realistic scenario.
Right. Currently, to hedge that specific fear, they basically have two bad options. They either have to sell down their underlying Microsoft position, which triggers massive tax liabilities,
Nobody wants that.
or they buy broad put options on the entire stock. But those puts might lose money if the software division beats earnings so badly that the overall stock rallies anyway.
So their hedge fails, even if they were right about the cloud division.
Exactly. But a KPI contract solves that exact dilemma. The institution could purchase a binary KPI contract that essentially states Microsoft's cloud revenue will fall below X billion dollars.
Wow.
If their specific fear materializes, the KPI contract pays out, perfectly offsetting that localized risk in their portfolio.
That's brilliant.
And if the cloud revenue holds up, they only lose the defined premium they paid for the contract, while their underlying $2 billion stock position continues to appreciate. It allows for surgical component-level risk management.
We're essentially talking about bringing prediction market mechanics right into the regulated, SEC-cleared environment. Retail traders already love prediction markets for binary events like, political elections or sports outcomes.
Huge markets.
Cboe wants to capture that exact demand, but apply it directly to corporate fundamentals. And this ties perfectly back to their CapEx spend on that proprietary clearinghouse we were just talking about.
Oh, right, because the clearing mechanism is different.
Completely different. A legacy clearinghouse like the OCC is built to calculate margin based on the historical volatility of a stock price.
Right.
But calculating the margin requirements for a binary, event-driven contract that's based on a corporate accounting metric, that is a fundamentally different mathematical challenge.
Yeah, the OCC would probably take years to model that.
Exactly. Having their own clearing agency allows Cboe to custom build the specific risk models required to launch these exotic contracts without waiting for third-party approval.
It's just so smart. And the distribution strategy for these new products is incredibly robust. Cboe highlighted that Charles Schwab is actually acting as an anchor tenant for their newly launched Cboe Predicts binary options.
Schwab is a massive partner.
Huge. And more importantly, management stressed that the demand for these new granular products is largely inbound.
Meaning people are asking for it.
Yes. And that is a massive de-risking factor. In financial innovation, the highest cost is often customer acquisition, right? Building a complex product and then spending millions in marketing to try and convince brokerages to actually offer it to their clients.
Yeah, pushing a boulder up a hill.
But here, the massive retail aggregators are going directly to Cboe. They're seeing the internal search data from their tens of millions of retail clients, and they are essentially telling Cboe, our users want to trade specific corporate metrics. Build the architecture, and we will integrate the API.
That is just incredible validation for the product.
It really is.
So, synthesizing this entire mosaic of data, we've covered the record revenue, the operating leverage, the structural shift in retail options volume, and these massive CapEx investments to unlock continuous trading in prediction markets.
What's the verdict?
We arrive at our bottom line verdict. From an investment perspective, this earnings call represents a fiercely bullish signal for Cboe Global Markets.
Fiercely bullish, I agree. The core of that bull thesis really relies on Cboe positioning itself right at the nexus of three distinct accelerating macro trends.
Let's hear them.
First is the enduring dominance of U.S. equity markets. Capital is just going to continue to consolidate where liquidity is deepest, and Cboe collects a toll on the data and execution of that liquidity.
Right.
Second is the permanent empowerment of the retail trader. The repeal of the PDT rule removed that final speed bump, and retail is now demonstrating a sustained appetite for complex, defined risk derivative strategies.
They aren't going away.
No, they aren't. And third is the broad transition toward component-level risk management, moving away from blunt instruments like shorting a whole stock and toward these hyper-specific, capital-efficient hedging tools like the KPI contracts.
And when a business successfully monetizes the intersection of those three trends, you see the result directly in the margins. 72% EBITDA margin and 45% bottom line growth.
The numbers don't lie.
They don't. For listeners currently holding Cboe equity, management is executing their strategic roadmap with absolute precision.
Hold tight and enjoy the ride, basically. But for listeners evaluating an entry point, we also have to look at capital allocation, specifically how management is treating their own stock.
The buybacks.
Yes. During the second quarter, Cboe deployed $33 million to repurchase approximately 127,000 shares of their own stock, and the average execution price for those buybacks was $256.61.
And the commentary surrounding that buyback from the CFO was exceptionally transparent, which you love to see.
Yeah, she didn't mince words.
Jill Griebenow pointed out that the stock experienced meaningful volatility and a notable decline in the final weeks of June. She explicitly characterized the valuation at that time as a, quote, notable discount in the stock.
She actually went even further than just calling it a discount. She openly stated on the call that the executive team wanted to be significantly more aggressive in repurchasing shares during that dip.
Really? Why didn't they?
They were legally restricted by the standard blackout periods that prevent executives from trading prior to the official earnings release.
Oh, of course.
But think about that signal. When the internal team, the people with real-time access to the order book and the unreleased revenue data, sees a dip and views it as a frustratingly missed opportunity to buy back their own equity.
Yeah.
That is the ultimate conviction signal for a retail investor. They know what the numbers are going to be and they want to buy.
It's a huge vote of confidence. But, as always, a responsible thesis requires acknowledging the potential headwinds, too.
Of course.
The most visible caveat on their balance sheet right now is a $650 million debt tranche that is scheduled to mature in the first quarter of 2027.
Yeah, and in a high interest rate environment, carrying a $650 million maturity can be a severe drag on cash flow, especially if the company is forced to refinance that debt at a punishingly high yield.
Right, refinancing right now is expensive.
Yeah.
But management preemptively neutralized that concern on the call, which was smart.
How so?
They highlighted that Cboe is currently sitting on $2.3 billion in adjusted cash.
$2.3 billion, okay.
Yeah. Their leverage ratio is extraordinarily low, sitting at just 0.7x. They are generating so much free cash flow that they anticipate simply retiring that debt using cash on hand when it comes due.
Just paid off in cash.
Exactly. They will not be forced into the debt markets to refinance, which completely protects their balance sheet from interest rate volatility.
That is a very luxurious position to be in. Furthermore, they are actively streamlining the organization to focus purely on high-margin growth. Management noted they are finalizing the divestiture of Cboe Australia in the third quarter, while simultaneously working through the sale of Cboe Canada.
Right, the international divestitures. This strategy of portfolio sharpening, as they call it, is expected to yield $40 million to $50 million in annualized savings.
That's significant.
It is.
Yeah.
In corporate finance, bigger is not always better if the peripheral assets drag down the overall margin profile.
True.
Selling off these international cash equity exchanges that just do not align perfectly with their core strength in U.S. derivatives and data, it allows them to reallocate that capital into the high growth initiatives we discussed.
Right, like the clearing infrastructure and the KPI contract.
Exactly. It demonstrates a highly disciplined capital allocation strategy. They are entirely focused on expanding their moat, where their competitive advantage is absolute.
Which brings us to the broader implications of this deep dive. Because the data we've unpacked today points to a fundamental evolution in market mechanics.
It really does.
Revisit the metaphor we started with. Historically, the institutions, those massive cargo ships, they dictated the terms of the market entirely.
They were in charge.
They provided the volume, they demanded the specific products, and Wall Street built the infrastructure exclusively for them. Retail traders were simply passengers, forced to accept whatever limited access they were granted.
But looking at this transcript, when everyday retail traders are consistently generating 57% of the volume in the hyper-fast SPX 0DTE market.
Right.
And when retail brokerages are the entities driving the inbound demand for complex derivative structures like binary KPI contracts.
You have to ask the provocative question, right? Has the power dynamic permanently inverted?
It's a great question.
Are we entering an era where the retail jet skis are actually providing the baseline liquidity, setting the pace of technological innovation, and forcing the legacy institutions to adapt to their trading behavior?
It certainly looks that way.
If Cboe's earnings report is any indication, the democratization of finance is no longer just some marketing slogan. It is a measurable structural reality that is forcing the plumbing of Wall Street to be entirely rebuilt.
And Cboe's the one building the pipes.
Exactly. And that wraps up this Talk Tickers edition of our deep dive. We really hope we've decoded the jargon, provided the vital context behind the numbers, and giving you the actionable insights necessary to evaluate this stock for your own portfolio.
Thanks for joining us.
We'll catch you on the next deep dive.